Hello, everybody out there in QuickBooks land. My name is Jason Ruvault, and I'm going to be your instructor for today's webinar on Accounting 101. Nail the basics so you're ready at tax time. There we go. So this is what we're going to be learning about today. Number one, we're going to learn about the chart of accounts. This is the hub of your accounting, and it's the most important thing to learn about in a class like this. Number two, we'll also be learning about financial statements, which are ways of interpreting the transactions you record and interpreting what you see on the chart of accounts, putting it all together in a way that's very readable, or at least much more readable than the chart of accounts is by itself. We'll also be talking about the importance of choosing the right account type. Now, that's the importance of choosing the right account type not only while you're setting it up, but also whenever you're using it. We'll talk about when to use different account types throughout this class. Number four, we'll talk about journal entries, what you need to know. Now, the short answer to that is you don't need to know a whole lot because QuickBooks Online actually takes care of a lot of the journal entries for you, which is quite a relief, I have to tell you, because journal entries can get pretty hairy if you don't quite know your debits and your credits. But we'll talk about that. Number five, we'll also talk about some essential accounting terms. And I'm going to sort of sprinkle those essential accounting terms throughout the webinar. But we'll also have a little bit of a recap towards the end of the webinar to wrap it up and just to remind everybody what these different terms mean. Because accounting is, it's kind of a language unto itself. And especially whenever you're speaking to an accountant, you might feel like you're speaking to, someone who's speaking in a different language. So we'll talk about those different phrases and important things that are relevant to you, important for you to know in your use of QuickBooks. Now, it's important to note that you don't have to be an accountant to use QuickBooks. You don't have to be a bookkeeper to use QuickBooks. But there are some accounting terms, there are some accounting guidelines that are important for you to understand to get the most out of the program. And that's mostly what we're going to be talking about today. I'm going to go ahead and put my screen up and then, whoops, hold on, let me put that back. I didn't mean to take myself away. I'm still going to be up there. I'm just going to be in my office rather than in front of a PowerPoint. So let's go ahead and jump into QuickBooks. Now I've got a company file built here for us to all explore together. And the first thing I want to show you is the chart of accounts for this particular business. We're going to get there by clicking on accounting. So whenever you go to your chart of accounts, this is basically a listing of all of the different ways that a business categorizes the money that it currently possesses and the money that it currently owes. It's also a list of ways for you to categorize why you made money or why you spent money. Essentially, any transaction that happens in a business is going to go through the chart of accounts. Anytime money changes hands or anytime you end up owing somebody or they owe you, it's always going to be recorded somehow on the chart of accounts. And by using the chart of accounts, we're then going to extract some information, put it onto financial statements, make it easier for us to read. Now, the chart of accounts by itself doesn't really give us a whole lot to go on. It's just a listing of words, basically. And if you're not familiar with what these words mean, it can be really confusing. So that's what we're going to learn about first. Now, I want to explain to you the basics of what's called double entry accounting. Double entry accounting means that whenever we record a transaction, there are two sides to that transaction. There's the debit and then there's the credit. Now, you don't really need to know debits and credits in order to understand this concept. One of the main ways that I always explain it is through source and use. Whenever there is a financial transaction, there is always a source of the money that's changing hands, and there's always a use for the money. So basically where the money is coming from, where the money is going to. If you're spending money to buy gasoline, the money is coming from your bank account because you're going to use a debit card, or maybe it's a credit card if you're spending money on a credit card, and it's going towards the purpose of purchasing gasoline. So that's the use. So whenever we record transactions, I'm going to go ahead and open up a transaction here. I'm going to open up an expense. We're actually going to see that. right here on the transaction form. You can also see this as you download transactions. So right up here, we're going to see the payment account. That's where the money is coming from. That's the source of the money. And then down here is the use. This is where we tell QuickBooks why we spent the money, or if we're receiving money from a customer, why we made the money. So source and use, there's always those two things. Now, whenever we click this drop down arrow to tell QuickBooks why we spent this money on an expense form or a bill or a check or whatever we're looking at, we're going to see this list of different categories. Well, these categories all come from the chart of accounts, each and every single one of them. And if you want to tell QuickBooks about a way in which you spend money or a way in which you make money that's not already on that chart of accounts, you need to set it up on the chart of accounts so you can start using it. So we also have, and I'm going to go ahead and show you where these expense accounts are on the chart of accounts, because they're not up at the top. Up at the top, we're just seeing bank accounts, we're seeing liability accounts, equity accounts. You don't see the expenses until you scroll down a little bit further. And here we're seeing our expenses right in here. So those were the accounts we were seeing earlier, like advertising, some auto repair, some fuel. Now, we've also got our liability accounts and asset accounts up here. So I'm going to give you another example. Spending money is pretty easy. You see where the money is coming from, where the money is going to. But let's say you get a loan. How do you record that? Well, we're going to go up here to our Create menu and then choose a bank deposit. Now, if you're getting money, there's still going to be a source and a use. The source of the money is right here in the account field, and the use is going to be it going into our checking account. So we're then going to take that money and go spend it on things. So right in here, we're going to enter basically where the money is coming from. Well, if we're borrowing money, it's going to come from a liability account. Liability accounts, when you'll find out more about this later, they track how much money you owe. I think most of you are probably familiar with the term liability. Liability means the things you owe or the things that you're liable for. So what we're going to do is we're going to select the liability account down here. And I've got one set up. We're going to go ahead and take out a small business loan. I'll just choose small business loan right here. We're going to say we're going to take out this loan from the bank. I don't know if I have bank set up as a vendor, but I'll go ahead and set them up right here. They're not a customer, they're going to be a vendor. And then we're going to borrow $50,000. So the money is coming from the loan and it's going into our checking account. So the two things that'll be affected here is the loan account and the checking account. Both are going to go up. That's kind of one of the miracles of debits and credits. You can actually increase two things at the same time or decrease two things at the same time or many things at the same time. So I'm going to go ahead and record this. Now, we're going to take a look at the balance of the checking account and the liability account. So right here, we can see that the checking account went up by $50,000. It was at $23,000. Now it's up to $73,000. And then whenever I scroll down here to my liability account, my small business loan, now it's at $61,000. I had a little bit of a loan before then. I can go ahead and look at a report over here. Just click that drop down arrow and then run a report, and I can see the individual transactions that make up that total. But here's that $50,000 right there that we just borrowed. So two sides to a transaction. Money where the money's coming from, where the money's going to. Every transaction in QuickBooks is like that. Sometimes it'll involve 4, 5, 6, 7, 8, 9, 10 different accounts, but there's always the same amount of money going into one side as it is in the other. That's the basics of accounting, and that's a kind of thing that can't be broken. Now, whenever we're looking at the chart of accounts, we're basically seeing all of the different transactions that we've ever entered for our business at the same time, going back from the very beginning of our business. So right up here, we're able to see all of the balances that we have for our assets, our liabilities, and our equity accounts. Basically what the business owns and what the business owes. And these balances are made up by the total of every transaction that has ever happened for that account. So right here for checking, it just, we've entered all of our different transactions for our checking account, and it just so happens that we've received $73,158.34 more than we paid out. That's why we have a positive balance. We've made more money into that account than we've spent out of it, $73,000 more. Now, whenever I scroll down though, I don't see balances for these income, cost of goods sold, or expense accounts. So why don't I see any balances there? Well, for the case of assets and liabilities and equity, QuickBooks is telling you how much money you have in that account right now. And that's an important thing to know. That way you don't spend more money than what you really have in your bank account. That's an important thing for you to know. Also, you might need to know from time to time how much money you owe right now on that loan. And like I said earlier, that's basically an accumulation of all the transactions that have ever happened. That's why that balance exists right there. But let's say we take all of the transactions that have ever occurred for an income account, design income. That would basically tell us all the money that the business has ever had ever for design income. That's not very helpful. What you probably want to know is how much money the business has made this year for income. That's what's going to help you file your taxes, right? Because whenever you file your taxes, you don't tell the government about how much money you've ever made. You just tell it about how much money you've made this year. So they don't give you numbers for these accounts. We have to dig a little bit deeper to get those numbers because what we want to see is a slice of the total amount of transactions, not all of them at the same time. So because of that, the chart of accounts is not the best place to go if you're looking for balances. The best places to go are going to be your financial statements. And accountants have devised two different financial statements to help you out. And we're going to take a look at both of them. Now, the first one, I'm going to go over here to my reports. You're going to find these in your favorite reports section, right up here at the top. The first one we're going to look at is the balance sheet. And the balance sheet shows you basically a snapshot. It's like taking a picture of your business right here, right now, at this very moment, because it's going to tell you your financial position. This is where you're at right now. So right here, we've got all of our bank accounts. So that's how much money we have in our bank accounts. We're all familiar with bank accounts. We know what those are for. And then we've also got accounts receivable. We've got accounts receivable, by the way, is the amount of money that customers currently owe you. So if you were to add up all of the open invoices and subtract out any open credits, that's the total that you would get right there as accounts receivable. We've got other current assets. Other current assets are things that the business owns that it plans to sell or convert into something else within a year. So inventory, money that you have on hand that you're going to be putting into a bank account, things like that. And then we've also got fixed assets. These are the big things that the business owns that is probably going to go through depreciation. So it's going to essentially be turned into an expense over time. That way you can get tax benefits over the course of several years instead of just one. Now I'm going to go ahead and collapse all these. Now we have $303,954.76 worth of assets. Now right down here we have liabilities and equity. Liabilities and equity are all the things that the business owes. So you might notice that the amount of assets equals the amount of liabilities and equity. And so the things that the business owns equals the things that the business owes. Now that doesn't exactly fill one with confidence, does it? Because it sounds like you're not making any money. If a business owes something for every, or owes something for everything that it owns, that doesn't sound good. But what you'll notice is that this bottom section, where the business sort of keeps track of what it owes, is divided up into two different sections. You've got liabilities, and then you've got equity. Liabilities are the things that the business owes to people outside of the business. Those are the bad people, right? Those, no, they're not necessarily bad, but we don't want that number to go up. Those are going to be creditors. Those are going to be credit cards. Those are going to be vendors, contractors, people that we owe money to outside of the business. Whereas equity is a measure of what the business owes to the owners. Now, the way that a business increases in value is that as you sell things, your assets are going to go up because you're going to be receiving money from your clients. That's going to be going into your bank account, which increases your assets. Now, whenever a business makes money, who gets to keep that money? It's the owner of the business, right? The owner gets to keep the profit of the business. So if the owner gets to keep the profit, that means that that's money that is owed to the owner, and that is going to increase equity. So as a business makes money, the assets go up naturally because you're depositing that money, and equity also goes up at the same time. So it's actually okay that the business owes all of this money because it can owe it to the good people, the owners of the business. Now, I'm going to go ahead and expand these things back out so we can take a look at it. Now, the liabilities, we have accounts payable. Accounts payable is the amount of money that the business owes on open bills right now. So think like utility bills, or if you have any open bills for inventory that you've purchased but you haven't paid for yet, that's going to be your bills. You've also got credit cards. We all know what those are. We've got long-term liabilities. So these are going to be like mortgages, car notes. You've got the small business loan that we had in there. There could also be some other current liabilities in here. Other current liabilities are things that the business owes that are probably going to be paid off within a year. So sales tax payable is going to be one of those accounts, but also short-term loans are going to be something you'll see as well. Equity is what the business owes to the owner. Now we got several things in here. We got opening balance equity. Opening balance equity is a measure of what the business was worth before it started using QuickBooks. So whenever you start using QuickBooks, basically you go in and you create a whole bunch of accounts in your chart of accounts telling QuickBooks, what you owe, how much money you have in your bank account at the beginning of the year. And that's what that is. Whenever you increase those balances of those accounts, it increases or decreases the opening balance equity. It's sort of just like a starting point for the business whenever you first began. A lot of people like to move that number over into an owner's equity account or like a retained earnings account or something like that to keep track of it. But there's also owner's contributions. Not everybody's going to have this, but this is the account where you would track the amount of money that the business's owner puts into the business, like deposits from their checking account over to the business. You've also got retained earnings. Retained earnings are basically a record of all of the profit that the business has made in previous years. It's a really important distinction there. That's for previous years, whereas net income is the profit for this year. Now, I get a lot of questions from people about how do I move this number over into this number? Because there's a concern that at the end of the year, you have to make like a journal entry to move your profit over into your retained earnings. But it doesn't quite work that way in QuickBooks. You can actually do this automatically, and I'll show you how to do it. So right now we're looking at a balance sheet that is as of June 5th, 2019. So the retained earnings is the sum of profit that we've made from December 31st, 2018 and before. So anything that happened before this year is retained earnings. Anything that happens this year is net income. Now I'm going to change this report. I'm going to change it so that instead of looking at it from the point of view of today, we're going to jump on our time machine. We're going to go look at our business from the point of view of the end of last year. We're going to see what happens to that retained earnings and net income account balance. So I'm just going to put that in really quick and then take like a mental snapshot, 156,000 and 20,000, okay? So I'm going to run this report again from the point of view of the end of last year, and we can see that these numbers are very different. So now we see net income of 68,000. So that was how much money we made last year in 2018. And now retained earnings says 87,000. So that's how much money we made from the end of 2017 and before. So see how it keeps on going back and back and back. It also works if we go forward. So remember, if we were to look at today, that net income is our profit for right now. Whenever we jump on our time machine and we go forward to 2020, which sounds, I guess it is the future. I was about to say it sounds like the future. I think it is. We're actually going to see this amount go into this amount. We don't have to do a journal entry, nothing like that. It does it automatically for us. We'll just change that date. We'll scroll down here to the bottom, and we can see exactly right that net income got folded into retained earnings. So you don't need to make any journal entries. These things happen automatically. Just enter the transactions as they occur. QuickBooks will take care of what is considered net income or retained earnings based upon, frankly, the dates that you enter onto your report. So it's really cool that way. So this is our balance sheet. Now, the main way that a business increases in equity is this little number right here. So it's a pretty important number. But before we go and we explain where that number comes from, I want to show you the basic accounting equation. And it is this. So all of our assets, $303,954. Let's say we take all that stuff, we sell it all off, we've got $303,000. We're going to put it all into, I don't know, we'll put it all into like a wheelbarrow. And so we've got a wheelbarrow full of money. Now, it'd be great if we get to keep it all, but we don't get to, right? We first got to pay the people that we owe money to. So we're going to have to go over to our creditors, our bank, all that. We're going to pay them their $79,265. Now, once we've paid them, the money that we get to keep is equity. That's what equity is. It's assets minus liabilities equals equity. And that's what the business is worth to the owner. Now, this number right here, this net income, comes from a very important financial statement as well. And we're going to go ahead and take a look at it. I'm going to open up in a different tab though. That way I can keep the balance sheet open. So I'm going to right click reports and then choose open link in a new tab. By the way, if you don't know how to do this, this is a really cool thing because that way you can have multiple tabs of QuickBooks Online open at the same time. So you can actually switch back and forth right here. Now in the second tab, I'm going to open up my profit and loss. Now earlier we talked about how we weren't able to see how much money we made or how much money we spent on various things because, you know, seeing all the transactions forever wouldn't really be very helpful, very descriptive. So that's why we have a profit and loss, because on the profit and loss report, we're able to see the performance of a business. Just like the balance sheet is sort of like the financial picture of a business, the profit and loss is sort of like a financial movie. It's your way of seeing where you started and where you're at right now and comparing those two together to see how much money you've made versus how much money you've spent. And so it's broken up into three parts. We see income. So this is the amount of money that the business has made off of sales. This is going to be your revenue. So all of your invoices, all of your sales receipts, this is what gets added up as your income. And then we've got, so that's our total income, $55,000. Then we got cost of goods sold. That's the amount of money that we've spent on inventory that we've sold. QuickBooks figures that out automatically. It could also be the amount of money that we've paid contractors to perform certain tasks for us that we charge customers for. It could be any sort of thing that we spend money on that is specifically for a sale. So we're talking about operating costs. We're not talking about overhead. Overhead is a separate thing. So any overhead is going to be down here in the expenses section. This is where we're going to see advertising, we're going to see rent, we're going to see processing fees, travel expenses, fuel. We'll see insurance, professional fees. Those are all going to be added up right here. We see totals for all of these things. Whenever you take all of your income, subtract out cost of goods sold, subtract out expenses, you get net income. Now this is the same number that we saw earlier on the balance sheet. Switch over to the balance sheet, there it is, exact same number. So that's where the balance sheet gets that number. That's where you're seeing whether or not the business is profitable, whether or not it's adding value for the owner of the business. So really important stuff. Now, all of these balances, all of these numbers that we're seeing right here are all coming from different transactions. As you record transactions, you tell QuickBooks where the money is coming from, where the money is going to, QuickBooks automatically populates all of these fields. So whenever we look over here at our balance sheet, we'll see the small business loan. If you'll recall, that's how we made that deposit earlier. And if we were to enter an expense for some fuel, we would see it over here on our profit and loss report. So whenever you go to file your taxes, you want to have this report as detailed and as helpful as possible, so that way you can figure out which different tax deductions to take, how much income you need to report, what cost of goods sold you need to report, what expenses you need to report. If you do everything right and you record all of your transactions properly, you're going to be able to look at this report and tell what it is that you need to fill out on different forms, or what you need to give to your accountant whenever they ask for it. Or maybe just give them this report and have them do it for you. Either way, this is what's going to help you out the most for those tasks. Now, you might say to yourself, it's great to say these things, but what about actually building a chart of accounts? What do we need to have on a chart of accounts? Let's go ahead and go look at a chart of accounts. Now, the short answer to that question, what do you need on a chart of accounts, is anything that is helpful for you to be able to see on a report, like the ones that I just showed you, and have it stand out by itself. It needs to be its own report. It needs to be its own account. So if it's important for you to track how much money you've spent on gasoline and have that stick out by itself on the profit and loss report, so that way whenever you're doing your taxes, you can figure out how much money you spend on gasoline, it should have its own account. So that way, whenever you go to run your profit and loss report, you can say, oh, okay, that's how much money we spent on fuel this year. So anything that's important for you in terms of running your business and seeing, how much money you've made on this thing versus this other thing, how much money you've spent on this thing versus this other thing, create an account for it. That's your way of tracking that. Also, if you need to track something specifically for taxes and there's some sort of tax benefit specifically for one way of spending money or one way of making money, it also needs to be its own account. Now, a lot of people will jump into the chart of accounts and they'll create accounts for all sorts of crazy things. They'll create an office supplies account, and then they'll create sub-accounts for pencils and pens. And then they'll create another sub-account for paper, and then another sub-account for like binders and folders. I've seen it. I've seen it happen. People will create a different account for each one of those things. I got to tell you, that's a little bit too much. You want it to be detailed, but you want it to be detailed in a way that's going to allow you to make better decisions. You want to be able to look at a profit and loss report, see the important things, but not see all of the little minutia that gets in the way of seeing the bigger picture. So, think about putting the forest on here instead of the trees. Because, if you get a little bit too distracted by the trees, it's difficult for you to see the big picture, for you to see that forest. Now, for the way for us to enter a new account on the chart of account is to click new right here. Super easy for us to add a new one on here. But before you do that, it's really a good idea for you to consider what sort of an account you're going to even try to set up. We got a couple of tools for you. First of all, I want to show you this right over here under My Accountant. Whenever you click My Accountant, if you've got an accountant, you can invite them. Just enter their email address right here and click invite. That sends them an email, and they're able to basically click a link. They'll enter a password. They'll set up an account for themselves. Free, doesn't cost you anything, doesn't cost them anything. And they'll be able to, from then on, log into your company file and maybe set up the accounts for you. If you're not comfortable working in a chart of accounts, that's fine. They will be, because all these different types of accounts we've been talking about are types of accounts that are ubiquitous in accounting. So they're going to know what these things are for. These are not specific to QuickBooks. They're going to know what a liability account is, an equity account, income account, all those things. Now, if you don't have an accountant, you can click Find a Pro to Help. And this allows you to search through a database of pro advisors. And so with pro advisors, these are people who have passed certification exams in QuickBooks, and they can basically, you can basically be assured that these people know what they're doing. And these are independent contractors. There's no set price for them. They set their own rates. And whenever you click on one of them, you can find out more about them, their experience, their rates, things like that. And you can search by location up here at the top. Now, also, I'm going to give you a couple of other cool things that are available in the reference guide. This is in the handout section, by the way. In the handout section, I'm going to go ahead and go down to the page. This is page, I can't really tell what page it is, but I guess it's about page 5 or so. You'll find in here the account types. And this is sort of a cheat sheet. So if you're ever stuck and you don't know which type of account to create as you're setting it up on your chart of accounts, just put in or just look right here at the different QuickBooks type accounts. This is for the balance sheet. And then there's also one for the profit and loss. And it tells you a description of each different type of account and then different examples for why you would actually need one of those accounts. So right here we see like long-term liabilities. Well, you know, if you're setting up a mortgage, right there it tells you that's mortgage payable. So gives you good examples, gives you good descriptions. Refer to this if you ever get stuck. And I want to give you one more thing, so we're feeling generous. I want to give you one more thing, and that's this right over here. It's called the Client Accountant Agreement. This is also in the handout section. This will, by the way, this will be emailed to you. If you don't see the handout section, it's okay. Don't worry. You'll get all these documents whenever you get the follow-up email 1 hour after this class. So this is the Client Accountant Agreement. If you've got an accountant or if you're looking to get one, this is a really cool document to have because this is where you can basically decide who's doing what. And you know, for a lot of these daily tasks, you'll probably do them yourselves or have a bookkeeper there at your business do them. Weekly tasks to pay period tasks. But you know, down here we got monthly tasks, quarterly tasks, annual tasks. And you can put the responsible party right there and put an X in to make sure that it's being covered and then put a date in. And this creates a situation where you're not really going to fall into one of those traps where, you know, you thought they were doing it, but they thought you were doing it, and it never gets done. Happens all the time, right? All the time. It won't with something like this. Or if it does, you can at least know who's accountable and be able to show them that document, letting them know that, you know, they were supposed to do this thing. So very helpful. And even if you're not going to be using an accountant and you just want to keep track of who's doing what in your business, this is something you can adapt for that too. So some pretty cool documents there for you to use in the handout section. Again, we'll email them out after this class is over if you don't grab them right now. Now, setting up a new account, super easy. All you got to do is click New up here at the top right. So if you recall, in those financial statements that we were looking at earlier, everything was in a very particular order. On the balance sheet, we had assets and then liabilities and then equity. Well, that's what happens here in the account listing too. Whenever you go to create a new account, you're going to see your assets first, and then you're going to see liability accounts, and then finally equity. And on the profit and loss report, you saw income, cost of goods sold, and expenses. Well, it's the same way here, because if we scroll down, there's income, cost of goods sold, and expenses. So it's going in the same exact order as the financial statements. It's also going in the same order as the balance sheet, or not the balance sheet, the chart of accounts. So let's set up a new account. I'm going to set up a new account so we can track the amount of money that we spend on consulting fees. We're going to hire a consultant. So right down here, we're going to choose an expense account. Now, one of the biggest questions people have about setting up accounts is when to use an asset versus an expense. Because whenever you're buying something or paying for something, it can kind of be either way, right? Now, an asset is something that the business owns and gets to keep for a long time, or even for a year or so. So if you buy a new computer, that'd be an asset because you buy it and you get to use it, close it, come back the next day and you can use it again. Wouldn't really be worth it if you just used it once and then you had to throw it away or it broke or something like that. So you can use it over and over again. That makes it an asset. But if you're paying for something that that goes away, like if you buy a bottle of water and then you drink that bottle of water, it's empty, it's gone, you've used it. That's an expense. Or if you pay somebody for a service, like some cleaning fees, well, they come in, they clean up the room, they leave, that's it. You got to pay them again if you want them to come over and do that service again. So those are going to be expenses. So in this case, we're going to be paying somebody for some consulting fees. The knowledge that we learn is going to be helpful for us forever. But if we want to get that knowledge again, we got to pay them again. So it's going to be an expense. Now the detail type, we've talked a lot about account types. We talked a lot about where things go on the different financial statements. Have you once heard me mention detail type? No, I don't think I've said it at all in this entire webinar. We're almost 40 minutes in. And that's because it's not very important. The detail type, all it does is it has a column right here on the chart of accounts, and that's it. And in fact, a lot of people even turn that column off because it just doesn't matter. The detail type doesn't actually do anything. So whenever you're entering a new account, this is the thing that matters. The account type is the one that matters. Detail type, take your best guess. You're not going to be wrong because there is no wrong answer. We're going to go ahead and say that this is for consulting. So we'll just say that this will be for legal and professional fees. That's actually appropriate. So the name will be consulting. Perfect. And then right here is also sub-account. We'll explore that here in a minute, but for right now, I'm just going to enter this as consulting. We'll save and close. And that account has been set up on my chart of accounts. Right here, I can type in filter for name, consulting, and there it is. So there's our expense account that we just created. Now, let's say I spend some money on consulting. I'm going to go up here to my create menu. You can also download this type of a transaction. I'm not downloading it right now just because, we're just trying to demonstrate the accounting behind the scenes in QuickBooks. If you download these things, it's perfectly fine. You'll just do it through the banking center instead. But I don't have anything downloaded in this business, so we're just entering them manually. Now with an expense type of transaction, the first thing we do is we enter who the transaction was with. So we're going to go over to Weisskopf Consulting, and they're going to be our consultant. We're going to spend money out of our checking account, and then the category is consulting fees. So we're going to pay them for some consulting. We'll say that this is for new business consultation. We're going to pay them $5,000. So we'll put in $5,000 right there. Now, what I should see on my financial statements is my checking account being lowered by $5,000 and consulting being increased by $5,000. So it's the source and the use. So we'll click save and close. We'll see what happens. Right here, we can see that our checking account went down. Perfect. By $5,000, in fact. And then whenever I go over here to my profit and loss report and I refresh it, because we got to refresh this report, now I can see consulting $5,000. So we can see where the money came from, where it went to. It's all we need to know. So when we look at a profit and loss report like this, especially over time as you add more accounts, you might notice that it gets a bit long, it gets a bit cluttered, it gets a bit disorganized, and so we might want to spruce it up a bit. Now, the best way to do that is by making things into sub-accounts. Sub-accounts allows you to nest different accounts underneath other accounts. So like for instance, up here, we've got landscaping services, which is a parent account. And then the sub-accounts are labor and materials. And then we've got sub-accounts for installation, maintenance and repair, and plants and soil. An example in the expenses section is professional fees. Here we can see all of our professional fees and then the different kinds of professional fees underneath it. The total right here is the total of all of these different things added up together, but we also see the individual ones. This is really nice because it helps us to organize these reports. It also helps us to organize our chart of accounts. But what's even better is that if I don't want someone to see that detail, like if I'm giving a profit and loss to a bank, they don't care how much money I've spent on accounting versus lawyer fees. They just want to see professional fees. That's all they care about. They don't want to see the detail. So if that's the case, I can click collapse right here, and it collapses those sub-accounts, makes the profit and loss a lot easier for me to read. Now, I don't even have to scroll all the way down to the bottom to look at the entire thing. So really helpful. Now, if I want to go back and see the detail again, no problem. I just click expand and it comes right back. Now, the way that we set that up is by setting up sub-accounts. So up here under the chart of accounts, I'm going to set up a sub-account. If I click on new, while you're setting up an account, if you want it to be a sub-account of another account, all you have to do is select is sub-account and then choose the parent right here in this box. That's it. You can also do that with an existing account. So our consulting account, we want to make that part of professional fees. So what I'm going to do is go and find it. We're going to go down to consulting. So scroll on down here. We will find consulting. There it is. We want that to be a sub-account of professional fees. We saw the professional fees earlier. So we want it to end up right here underneath professional fees. So I'll go back up and find consulting. We're going to edit this. Click the drop down here and choose edit. By the way, if you ever need to make an account go away, you can also choose to make it inactive, and that'll take it off of this list. If you're worried about affecting past transactions, don't. It's not going to affect any of your past transactions at all. It only makes it go away for the future. So whenever you're filling out a new transaction, it won't show up as an option. So it makes it a little bit easier if you've got like a long chart of accounts, you don't want to use any old accounts anymore. So we're going to edit this one. and I'm going to choose is sub-account. Now I want to make this a sub-account of legal, or no, it wasn't legal and professional fees. It was just professional fees. Yeah, there we go. So I'll choose professional fees. Perfect. So there's professional fees. I'll save and close that. Consulting is going to move further down the chart of accounts. And now we see professional fees, and there's consulting right there, right where I want it to be. Now let's go run that profit and loss report again to see where it moved to. I'll run this report, scroll down, and there's consulting right there. There's the $5,000, and it also contributes to the total for all the professional fees. So you can organize your chart of accounts. You can also organize your profit and loss report and your balance sheet with these sub-accounts. And you can actually have 5 levels deep for your sub-accounts. You can have sub-accounts of sub-accounts of sub-accounts of sub-accounts of an account. It's actually tough for me to keep track of all this. Hopefully I got it right. I think I did. But it is 5 steps deep for these different accounts. Now, whenever you're looking at a financial statement, like the profit and loss report, it's going to be on one of 2 different accounting methods, the accrual method or the cash method. Now, whenever you basically set up your business, you're going to be choosing whether you file under the accrual method or the cash method. And essentially, these 2 different accounting methods determine when your business counts something as being income or expenses. Do you count it as soon as the invoice is created or as soon as the bill is created? Or do you count it as soon as you receive payment on the invoice or as soon as you pay the bill? That's the difference between the 2 different accounting methods. Now, under the accrual method, businesses consider sales to be income even if they haven't received the money yet. So if you've issued an invoice to somebody and the invoice is still open, if you're on the accrual method, that's still income. So whenever you file your taxes, you're still going to be reporting that as being income. Same thing for expenses, though. Now, under the cash basis, you're only going to see the money that you've received or the money that you've paid. Now, the biggest difference that you're going to see between these 2 different accounting bases is that all of the income that is currently in accounts receivable, which I mentioned earlier being all the money that customers owe you. So all of this right here, usually the other side of that is going to be income. So if accounts receivable goes up, income also goes up because of the invoices that you create. Well, the income is only going to be reported on a cash basis if you've actually made it, if you've actually received it. So open invoices don't show up. So whenever I switch over to cash right here, watch this income. It's going to go down. We're going to run this report again. So on the cash basis, our income is $46,900. It's about $10,000 less because this is only showing us what we've actually received. We're probably also going to see a similar reduction in cost of goods sold and expenses. So cost of goods sold is $9,500. Expenses are, let's see, $31,000. This could also show up or have a difference in inventory, by the way, if you have a bill for inventory. So we've got cost of goods sold didn't change. That's pretty normal, but expenses changed a little bit. So, you know, like I said, the AP can sometimes be wrapped up in inventory, so you might not see a huge change for your profit and loss report. You'll see a bigger change in your balance sheet because that's where your assets go. But that's the difference between cash and accrual. It's just a matter of when you count income or expenses happening for your business. And one of the last things I want to talk to you about, not the last thing, but close to it, is journal entries. Now, everybody has concerns for journal entries, concerns for debits and credits, especially once you get into bookkeeping. Everybody's worried about those debits and credits. Well, in all this time that we've been covering in this class, we've talked about all this accounting stuff. I've once mentioned debits. Well, I think I mentioned debits and credits at the very beginning, but we haven't actually seen them. And the good news is that you don't have to, because whenever you record a transaction like us spending money on consulting earlier, I didn't have to record the debits and the credits, but they're still happening. They're going on behind the scenes where I can't see them and where I also can't get them wrong, which is also really helpful, especially if you don't know them very well. So you can see at any time the debits and the credits in a transaction, all you have to do is click More and then Transaction Journal. Now, this isn't going to be something that everybody needs to take a look at, but if you're curious about what accounts are being affected by a transaction, a transaction like this is pretty simple. You're able to see those accounts right here. But if you're on an invoice, you're not actually going to see the actual income accounts or cost of goods sold accounts because you're going to see the items you're selling, not the actual income accounts. So in those, it's a little bit more helpful. But in a transaction journal, you're going to see the actual debits and credits that are going on with a particular transaction. And right here, we're looking at this one. In this case, the consulting account is being debited for $5,000, and then checking is being credited by $5,000. So, each side is equal, just like we were discussing earlier. Now, you might look at this and think, well, that's strange because we spent money out of checking. Why is it being credited? Credits usually indicate something going up, right? Well, in the topsy-turvy world of accounting, debits and credits don't mean up and down. They actually mean left and right. So a debit is the left side of a transaction and a credit is the right side of a transaction. And that's all they mean. They don't have anything to do with something going up or being credited or being debited in terms of going up or down, or debit cards or credit cards or anything like that. It's just left and right. Left side of a transaction, right side of a transaction. And different types of accounts are increased or decreased based upon whether they are debited or credited. And when an asset is credited, its balance is reduced. That's what happens. Seems crazy, but that's how it works. And whenever you debit an expense account, it goes up. You don't have to know this to use QuickBooks. All you have to know is that QuickBooks knows how to do this. And that's what matters. And it does, because that's what we're seeing right here on the screen. So that's the basic underlying journal entry for a transaction like this. We don't need to know these things. But if you ever find yourself in a situation where you do need to enter a journal entry, and that's rare, you can do so by clicking the Create menu and then choosing Journal Entry right here underneath Other. Now, I want you to be very careful about journal entries, because if you are in a situation where money is actually changing hands, you're going to want to use a regular transaction. The reason I say that is that journal entries do not populate onto reports very well. They show up just fine on profit and loss reports and balance sheets, but if you record all of your sales with journal entries, you're not going to be able to run a sales report. If you record all of your purchases with journal entries, you're not going to be able to run reports telling you about your inventory or your purchases from vendors. So it really limits the reports that you can run. Journal entries should be used very sparingly, and they should only be used under very certain circumstances, one of which is to fix errors. If you've been recording a transaction the wrong way all year, you have two choices. You either go back and you fix all of those wrong transactions, or you can have your accountant give you a journal entry and fix it all with one journal entry. Pretty helpful, I would say. Definitely saves you a lot of time. That's one instance. Another instance would be if you need to enter some depreciation. So depreciation would be something where you buy a fixed asset and you want to spread the expenses on your tax filings over the course of multiple years. That way, instead of getting just tax benefits 1 year, you get to sort of amortize it and spread it out over the course of multiple years. So depreciation is also performed through a journal entry. I'll go ahead and open up a journal entry right here and show you a typical depreciation journal entry. Now, QuickBooks is not going to calculate your depreciation. QuickBooks doesn't do that. There are a lot of different calculators out there, tons of depreciation calculators that will do that for you. Your accountant can also do it for you. It's not that complicated, but there are a lot of different types of depreciation. I guess I should say methods for depreciation. It's also different in different countries. So there's no automated way to do it here. But the journal entry for it is very simple. Once you know the amount that needs to be depreciated every month or every year, all you have to do is enter 2 lines, and that's it. So the first thing, whenever you record a depreciation, is we're going to record the debit side of this. Now that's going to be through an expense account. It's going to be depreciation expense It's an expense account. And we're going to go ahead and depreciate our fixed asset truck by $500. So here for the debits, I'll put in 500, and for the description, we'll enter monthly depreciation of truck. And then in the second line, we're going to click our drop-down arrow, and we've got a fixed asset named truck. And a couple of different ways that people do this. Sometimes people will set up their fixed asset as a single fixed asset, and then they'll have another fixed asset called accumulated depreciation that they use for all of the accumulated depreciation for all of their different assets. Sometimes people make accumulated depreciation a sub-account of the fixed asset. Either way is fine. We did it this way to make it into a sub-account. The original purchase is one sub-account, accumulated depreciation is another. And QuickBooks automatically fills in the credit amount and the description for us. So we don't have to do any more work. We're good to go. We're gonna go ahead and save and close this one. Make sure the date is right on journal entries, because sometimes they're supposed to be at the end of the year or at the end of a month or something like that. So sometimes you have to be particular about them. But that's it. And that's a depreciation journal entry. Whenever we go to look at our profit and loss report and we go down to look at depreciation expenses, we'll see it in here. Just click on that number and we'll see all the different depreciation entries, and we'll know that that was the total depreciation that we've had on our assets over the course of a year. And that's important to know for tax purposes. So those are the basics of accounting 101. Hopefully you enjoyed the class. Talk to you later on, and happy QuickBooksing.